Most traders see this candle and think it's a perfect mitigation block setup. They enter immediately, set their stop, and wait. But price reverses violently. Why does this happen? Today, I'm going to show you the most common mistakes traders make with mitigation blocks and how to avoid them. If you ignore this, your trades will fail 70% of the time, even if you follow all the textbook rules. A mitigation block forms when price displaces aggressively from a level, leaving behind a candle where large orders were active. That displacement tells you institutions entered the market with urgency. The candle itself is not the edge. The candle is simply evidence. Mitigation blocks are not defined by candle color, size, or time frame. A bullish or bearish candle can be a mitigation block. What matters is that price left the level with strength and did not trade fairly through it. That inefficiency means some orders were likely left unfilled. When price later returns to that area, institutions may use it to mitigate exposure, rebalance positions, or reduce risk. That process is what creates reactions. Mitigation blocks do not predict reversals. They do not force price to react. They only highlight areas where reactions are possible if the surrounding market conditions support it. Let's look at a clean example where a mitigation block works as expected. On the higher time frame, price is in a clear bullish structure. Higher highs and higher lows are intact. There is no structural violation. At some point, price creates a strong impulsive move to the upside. Within that impulse, there is a bearish candle just before price accelerates higher. That bearish candle is the mitigation block. Many traders assume this is a sell zone simply because the candle is bearish. That assumption is incorrect. This candle exists because institutions sold into strength to manage entries, not because the market turned bearish. When price retraces, it comes back into the mitigation block. Before any reaction occurs, price sweeps a local low on the lower time frame. That sweep removes weak sellers and provides liquidity. After the sweep, price fails to continue lower and breaks above a short-term lower high. Only then does price react strongly to the upside. The mitigation block worked because it aligned with bullish structure, followed a valid displacement, and was activated after liquidity was taken. The mitigation block is always identified on the 4-hour chart. The 4-hour time frame defines the overall market structure, the direction of displacement, and the directional bias. A mitigation block on this time frame only defines location. It does not provide entries, timing, or confirmation. Its sole purpose is to highlight where price is allowed to react if the broader structure remains intact. Execution is done exclusively on the 15-minute chart. Once price trades into the 4-hour mitigation block, attention shifts to the 15-minute time frame. On this chart, you wait for price to sweep a local high or low, removing short-term liquidity. That sweep is required. Without it, no trade is taken. After the sweep, price must break a 15-minute structure level, showing a failure to continue in the retracement direction. This sequence confirms that mitigation is actively occurring rather than anticipated. The entry is taken on the pullback that forms after the 15-minute structure break inside the developing internal range. The stop is placed beyond the 15-minute liquidity sweep, not beyond the entire 4-hour mitigation block. This ties risk to actual market invalidation instead of arbitrary zone size and keeps the trade efficient. Targets are set toward internal liquidity on the 15-minute first, with final targets aimed at external liquidity aligned with the 4-hour structure. This 4-hour for location and 15-minute for execution model removes ambiguity and prevents most premature mitigation block entries. Now, look at a second example with a different outcome. The candle looks similar. The displacement looks aggressive. But the context is different. In this case, price previously broke a higher timeframe swing low. Structure has shifted bearish. The most recent bullish candle before the downside displacement now becomes a bearish mitigation block. When price retraces into this block, the reaction is downward, not upward. The mitigation block works here because it aligns with the new bearish structure. Traders who fail in this scenario usually make one mistake. They treat mitigation blocks as fixed patterns instead of context-dependent tools. Same candle type, same shape, completely different meaning. The difference is structure. Mitigation blocks only make sense when they agree with the current market narrative. Without that alignment, they are just candles on a chart. The most common mistake traders make is entering as soon as price touches the mitigation block. Touching the zone means nothing by itself. A mitigation block defines where price may react, not when it will react. Institutions do not defend levels blindly. They wait for liquidity. In many failed trades, price retraces into a mitigation block without sweeping internal liquidity first. Traders enter early, price continues through the zone, and stops are hit. The mitigation block didn't fail. Mitigation never happened. Another mistake is trading mitigation blocks against structure. Traders see a clean-looking block and ignore the fact that structure has already shifted. In that case, the block is either invalid or represents mitigation in the opposite direction. These two mistakes, early entry and ignoring structure, account for the majority of failed mitigation block trades. Here is the filter that removes most low-quality mitigation block setups. A mitigation block is only tradable if it forms after clear displacement that aligns with higher timeframe structure. Price must retrace into the block without violating that structure. Before any entry is considered, price should sweep internal liquidity. After that sweep, price must fail to continue in the retracement direction and show a short-term structure shift. If price touches the mitigation block and immediately reacts without taking liquidity, you do nothing. If structure is unclear or broken, you do nothing. The mitigation block controls location. Liquidity and structure control timing. If all three are not present, the trade is ignored completely. This rule alone filters out most losing mitigation block trades. If you haven't watched my inducement and zones video yet, watch it first. This mitigation block model assumes you already understand how inducement pulls price into key levels. Without that context, you'll trade mitigation blocks blindly and turn high-quality zones into random entries. Mitigation blocks are not shortcuts, and they are not standalone setups. They are tools for understanding institutional behavior. When you apply them with structure, displacement, and liquidity, they become consistent. When you don't, they feel random. Focus on qualification, not frequency. That's how mitigation blocks actually work.